So on this topic, the topic is highly focusing on deferred taxes, but we can mention a few on the current, then we will go to deferred. So let's have some small write-ups. Recording already. So right there and say, the objective. Ruth, be ready. So you say the objective of IS 12, the objective of IS number 12 is to prescribe the accounting treatment, for income taxes. Remember this one we are writing from the back, the accounting treatment for income taxes. Full stop. Full stop. The current taxes under consideration, are the income taxes under consideration are current and deferred taxes. Income taxes under consideration are current and deferred taxes. Full stop. Let's start with current tax. Current tax, which I've said we are not going to waste much time. Current tax, you say, these are tax liabilities, stock assets. These are tax liabilities, stock assets. Tax liabilities, stock assets, which are assessed on taxable profits. Which are assessed on taxable profits. On taxable profits. Full stop. Down there, you say current tax is equals to taxable profits times the tax rates, where taxable profits is equals to reported accounting profits, before tax plus disallowable expenses minus the allowable expenses. Good examples of the disallowable expenses. One good example is which one? Depreciation. And one of the good examples, in fact, for accounting and health tax, they have so many. I believe what. Here, the good example is where and what? Where and tear. So for you to get the taxable profits, you start with the reported accounting profits, then you add back the disallowable expenses. Those are expenses which you ought not to have subtracted initially. Then you subtract the allowable expenses. Whatever you get, you subject to tax rate and you get the current tax. We proceed. Another point there, you say current tax for the current and prior periods. Current tax for the current and prior periods. Prior periods is recognized as a liability. Is recognized as a liability. Is recognized as a liability to the extent that it has not yet been settled, to the extent that it has not yet been settled, it has not yet been settled, and as an asset, to the extent, that the amount already paid, exceeds the amount due. Full stop. So if you pay in excess of what is due, then we recognize current tax what? Asset. So examiner can ask you, how do we recognize current taxes? So they are recognized as a liability to the extent that the amount due has not yet been paid or settled. And if you settle more than what is due, we recognize a current tax asset. Down there, you say current tax assets and liabilities. Current tax assets and liabilities. Tax and liabilities are measured at the amount expected. Are measured at the amount expected to be paid to. Or recovered from taxation authorities. Recovered from taxation authorities. Using the relevant, Nora will send, using the relevant tax rates. Using the relevant tax rates, stroke laws. Tax rates, stroke laws. Full stop. As I said, this topic is not focusing much on current tax. So even there is only one question, I think in 2015, a certain pilot paper, I think if time allows us, we're going to check. They were asking something small about current tax. So I want to bring a small illustration because what they have been examining is deferred. So I'm just bringing a small illustration. We work it out, then I jump to deferred tax. So write for me this illustration. Write this illustration very fast. A company. A company purchased an item of PPE. A company purchased an item of PPE for shillings 1 million. For shillings 1 million on 1st January 2021. On 1st January 2021. Full stop. Depreciation is provided. Depreciation is provided at the rate of 20% per annum on cost. Depreciation is provided at the rate of 20% per annum on cost. How much? 20% per annum on cost. While wear and tear is allowed, wear and tear is allowed at the rate of 25% per annum on costs. 25% per annum on cost. Full stop. The company reported profit after tax. The company reported profit after tax. Reported profit after tax of shilling 700,000. 700,000 for the year ended 31st December 2021. For the year ended 31st December 2021. Full stop. Correct. Required, calculate the current tax liability stroke asset. Calculate the current tax liabilities, but hakuna asset, itakuwa liability. So you're the people who are doing for me that, because I've already given you the formula. You take taxable profit times the tax rate. So you know how to get the taxable profits. So can you calculate for me and tell me how much is the tax? Then from there, I will just go straight. We'll go straight to where? The fund. Required is calculate current tax, Susan. Calculate current tax liability. Yes, current tax liability, just like that. So calculate from there. See, formula formula is here, everything is there. Shamaliza. Oh, where are you intimidating? Huh? You are done. For it. Huh? Hiyo ni hot air. Yeah, mimi naona hiyo. Reported profit after tax is 700,000. Reported profit after tax is 700,000. 700,000. So give me the answer. Who has gotten the answer? Any answer you get, you just forward. No victimization. Watu walimoni kwa hapa jana walikuwa wananipeleka mbio na answers. Where are the answers now? Thomas, were you there yesterday? Alikuwa ananipeleka na answers mbio. So I expect those answers also here. So I can see Adan 195, Mary 195, assuming tax rate is 30%. Yes. Oh, by the way, tax rate is 30%. Tax rate is 30%. Don't say 16%. Tax rate is 30%. Wear and tear rate is 25%. Yes, Joyce, it is 25. So I can see Adan 195, Mary 195. 195. 195. Those are 4, at least 5. One more. Hey, Thomas. 195. Umefanya kweli? I haven't done it, but I think 195 is wrong. Kuna kitu nimewawekea hapo kidogo, usipoiona unaenda nje. It's a very small thing. You need to be very careful. There is something, Apple. There is something you really need to say. So I've ruled out 195. Even that 199, I don't really think if it is correct. One person should be able to see. Kuna kitu nimeweka hapo kidogo. It's a very small element. Sasa si ufanye ndio hiyo. Is your profit after tax? Sasa si kama umeshajua, now work with it. The issue is that profit, there is no way you can work with it straight. How you have already been given profit after tax? How do you calculate profit after tax from? How do you calculate tax from profit after tax? Do something. Do something. 285, Sharon. Yeah, 285 is correct. So the correct answer is 285. 285 should be accurate. So let us calculate the taxable profits. So taxable profits, you start by reported what? Profit before what? Tax. You cannot work with after tax. After tax, tax tayari. So you have to cross back the after to before. So after we were given us how much? 700. So can you convert it to before tax? If the tax rate is 30%, then before tax will just be 700 divided by 2. Is that true?
Yes.
Which can even be proven. If you say PBT is X, we don't know how much it was. Less what? Less tax, 30%. So 30% will be 30% of X, which will be 0 point. Is that true?
Yes.
Yes. So it means PAT is how much? 0.7x. And the 0.7x is what we have been given to be how much? 700. So to get x, just divide by 0.7. Don't go to that long reasoning. If the tax rate is 30 and you have PBT, just divide by 70%, you will get back. So it means profit before tax is how much? 1 million. You kichapa 30 zinakuwa 300, so kitoa inabaki 7. Then now you add back the disallowable, which is depreciation. Depreciation is 20% of the cost of the asset. The cost of the asset was 1 million, so that is 200. Then you less out the wear and tear. So wear and tear allowance is 25% of the 1 million, that is 250. Therefore, taxable profit is this base 50, 950. Right? Therefore, current tax is 950 by 30%, which comes to 285. So I think some people went straight to take the PAT, and that was my main concern, so that you be keen on that, so that you don't make that mistake as we progress into the future. So now, having done that, let's go to number 2 I told you current tax, we don't stay there. Current tax, when you find it for specialization. When I specialize in tax. How many people are specializing here in MA? That's management account. That is correct. And they say, they say that at most two. You can specialize in two. At most two, at least one. And they say if you have decided to, like, uchukue MA na tax, then you put a tax work in MA. Lazima umalize hiyo MA pia. So you don't take two, then once you have passed one, you say it's enough. If you pick two, you have to finish the two. And if you take one and you finish, you don't come back to say now I want another one. See what I'm saying? If you pick one and finish, man, that will be one. And if you take two, you have to stick with the two until you finish. So be careful. If you have failed, see on this out. So you forgot like deferred tax. So for deferred tax, here we have to discuss and understand it properly. You keep maledanga shida. Even the auditors around, you can attest. Now, deferred taxes arises in so many ways. Let me start with the kawaida ways, then we come to the big issue. One, when you buy an asset, let's say you have a matatu here in Nairobi. Is there any tax obligation you have? Are you supposed to pay any tax if you have a matatu here around? Kuna tax yoyote? Kuna tax mtu anafaa kulipa. Ati hakuna? Mwenye matatu ana operate tu anakula. Kwani advance tax ni gani? It is taxed on commercial vehicles. Yes, so there is advance tax which is on the commercial vehicles. What hizo gari zinaendanga inspection kama ya hujalipa hiyo tax, lazima ulipe hiyo inspection. Now, which year, assuming this matatu was to last, the useful life is 6 years. The 6 kweli. Nairobi lifespan of matatu inakuwa roughly 6 ni sawa. Ama 10? 6. In which year do you expect to receive much cash flow? Year 1 to year 6. Where do you expect to receive much? Year 1. So if you are receiving much in year 1, then you as an accountant, you know very well that even if the asset is old in year 6, KRA still, you will have to pay what? Tax. There is advance tax which is paid on commercial vehicles. So you will still have to pay the tax. But now you see the cash flow will have gone down. So you can be smart to save. You say that, fine, every year I see that I'm paying around 50,000 for tax. Right now I'm getting much cash flow. Let me set aside some funds that when my revenue goes down, I have sufficient amounts to pay for what? Taxes. Then you go to your account, your books of accounts, that is, then you expense with something called deferred what? Tax. So deferred tax can arise in that way that a company or an individual, they set aside some funds to cater for future tax obligations. You anticipate and you are very sure that you will pay. Then what you can do now is to make a provision. Deferred tax actually is a provision. You make a provision that you will pay those taxes in future. That is 1. 2, right now we have computed current tax to be 285. But for some reasons which can be justified, you cannot pay. The company maybe mechomeka or something has just happened. You still have a right to, you can talk to the commissioner for now. We are not able to pay for this reason. So if accepted, then you can commit to pay maybe in 2025. Then in the books, that one will be recorded as deferred what? Tax. So deferred tax can be actual tax payable in the current year, but due to some reasons, it will be paid in the future. That is current tax again. Number 3, which is the one I really want you to understand. I want you to tell me how the income tax operates here in Kenya. Income tax. How do we pay income tax? I mean, we pay income tax once a year after audit. So tunalipa installments. Yes. Installments. So we go to start. The first installment. So the year started in January. The first installment is in which month? Assuming not farming, what we're farming were called a special case. April, is it? Student 20th, right? So 20th April, Here again. July, June. We have every 4 months. So in a July, whichever June or whichever J. Then Kuna. Then if you know now December, utakuwa umefunga vitabu. And this is a mistake I know. Most of people are financial. People don't pay installment tax. Kama Thomas anasema tunangoja next year tunalipa. Ukishafanya audit. Hapana. Once umefunga mwaka December, the following year you need to estimate. And you estimate based on what you saw last year. If last year we paid tax of 200,000, 200, the taxman allows you to estimate at what percentage for this year? 110. So, yes, you estimate 110 of what you paid last year. So once you have estimated at 110, assuming it is 220, then this 220 you can divide by 4. So you'll be paying. Is that 220 divided by 40? 55. So here we pay 55, 55, 55, 55. Then at the end of December, the reality will be known. So then you realize you underpaid. So instead of 220, the actual position is now maybe 230. It means you have a balance of 10. That 10 you pay the following year again in April. So that's how it operates. Yes, that is how it operates. Then, now to make matters worse, very worse, so that we unasema auditor. Wao wanakuja kufanya audit for this year and make the returns on or before when? 30th of June. Hapo ndio tunamalizana na auditor kabisa, mambo ya last year imeisha. It ends here. So the final income tax is paid here based on the assessment which accountant got here after preparing the books. The now taxman will come to do the audit and file the returns at this stage. Be rest assured, because you know accountant when preparing the books, there are some expenses which they will subtract. Like, let me just use the obvious. They will subtract expenses like which one? Depreciation. But for tax purposes, when determining taxable profit, you know these are accounting profit. Taxable profit, this one will not be subtracted. Instead, it will be added back as disallowable. Sure. So you will realize that the profit from which the final tax was estimated is totally different with the taxable profit. And that variation definitely will bring tax issue. So no. See, unajua huyo ali-estimate na akafanya final tax based on the profit they got here. And you know the expenses which they subtract, like accountant will subtract depreciation, donation. That's case some donations you are not supposed to subtract. Sure. Yes. Then when now the audit comes, they will disallow some of the expenses, donations, directors, entertainments, all those will be added back. So you'll find that the taxable profit is totally different with the accounting profit. Definitely it will bring a tax issue. So a smart accountant based on past experience, what you will do after doing your books, you can have an estimate in the P&L that I know any moment I do my profit and I pay tax will differ. We will differ with the taxman who is auditor here. So I make a provision in the P&L, provision for deferred what? Tax, to avoid overestimating your profits. So the expense, they make a provision for deferred tax. Should there be? Because I can estimate, because you know assets are on classes. We have class 1, 2, 3, 4. So if you have motor vehicles which you can estimate are in class 4, class 1 in what percentage? 37.5. I mean, I forgot. 37, no, 37, 30, 25, and 12.5, whichever. So if you are charging depreciation, but those rates are still there. So we estimate within the range, like the question we have done, accountant now taxman will a difference of 5%. Wear and tear was 25, depreciation was 20. You know, depreciation is for accountant, wear and tear is for tax purposes. So I can make a provision for deferred tax based on that 5%. Then I make a provision in the books. So when you make a provision, because you are anticipating that taxable profit will be different with the accounting profit, that tax you are making right now is also known as deferred tax. So Monica, what happens if you didn't have a tax payable the previous year? Okay, the rule is you're supposed to estimate what you paid last year to take 110%. So Ngara is asking, what if last year you paid nothing? What are you going to project? You project 0. In that case, you can project 0, but you can study the trend from January to April. You can see the movement, but still there is no problem. You can fail to pay the installment, then you will pay penalty. Still 20%. So there's still no problem. So now, for the assets, accountant will, on this date, in December, accountant will assess tax based on the net book values. Net book value is the cost of the asset minus accumulated what? Depreciation. So they assess tax on assets based on the net book value. When taxman comes, taxman will assess tax on the assets based on what is called written down what? Value. Taxman uses written down value, not net book value, which actually written down value is known as tax what? Tax base. Net book value is known as the carrying amount. So this is the cost, not minus accumulated depreciation, but minus accumulated. Actually, let me be very specific. Where and what? There. So there will be automatically there will be that difference. And when you check the difference keenly, it is being brought by this and this one here. Because the cost of the asset will remain constant. What brings the difference is the disallowable and the allowables. So taxman, so deferred tax will arise because the accountant will have assessed tax on the asset based on the net book value. This one here will assess based on the tax basis, which is the written down value. So as smart accountant, you just make a provision. You expense the book so that you don't overstate profits. Kama kuna tax will be comfortable to pay without any problem. Susan, what about new businesses who have never known their profits? You wait. Now that one you wait. You wait until you know. But if you are overambitious, you can pay something small because whatever you're paid in excess, you can also claim as a tax credit. So there is no issue. You can just say, from the looks, I'll make a profit of 100, spread it for 4, pay. If at all you will make a loss, then that tax credit will still remain on your account. So there's no big issue. So let's write something on deferred tax, but ideally, you may part a small concept on the deferred tax. Yes, so on Monday, those companies, because I know 90% of us here are accountants, and 90% of the entities where these accountants are not making provision for deferred tax. So can you go and ask them, why don't we make provision for deferred taxes? So right there, say, deferred tax are future tax obligations, are future tax obligations, are future tax obligations. Full stop. Full stop. Terminologies. There are some terms we normally use on deferred tax, which let me just capture them at this stage. Terminologies. Terminologies. So terminology number one, start with this one, tax base. Let's start with tax base. Tax base, in bracket, written down value. Tax base is the written down value. Tax base is the written down value, say, is the amount attributable to an asset or liability, an amount attributable to an asset or liability, attributable to an asset or liability for tax purposes. For tax purposes. For tax purposes. Full stop. As simple as that. Number two, temporary differences. Carrying amount. Temporary differences. Temporary differences. Temporary differences. Then you say, is the difference between the carrying amount, the difference between the carrying amount in bracket NBV, between the carrying amount of an asset, the carrying amount of an asset or liability, and its tax base, Full stop. You can even write for it a formula there. Not necessary, but you can from that definition. Actually, temporary is going to be everything for us in our questions. So you can even say temporary differences is equals to, we have said is the carrying amount minus what? Minus the tax base. Hiyo shikilia kwa mfuko throughout. It is the carrying amount minus the tax base. Let's proceed. Carrying amounts. Carrying amount. Then you say, is the amount at which an asset stock liability, is recorded. Asset stock liability is recorded in the statement of financial position. In a statement of financial position. A statement of financial position. Full stop. Types. Types of temporary differences. So they are normally two. Types of temporary differences. Types of temporary differences. We have what is called taxable. We have taxable temporary differences. And we have, how do you read this? Deductible temporary differences. We have those two. I've seen them asking you to explain the two types. We'll see them in those questions. So let's start with the taxable. Taxable. Then you say, actually, taxable, so for me to minimize a lot of notes, taxable temporary difference is also known as positive. They are known as positive temporary differences. These ones are known as negative. Negative is another name, temporary differences. And before we write, let me explain something small so that we can have an easy road. How do we get temporary difference? What is the formula? From what we have written? Carrying amount. Because carrying amount the accountant they wanaanzanga in December. Then taxman will come later. So minus what? Tax base. So when the carrying amount is more than the tax base. Let's say this is 100, this is 50. We report a positive figure. So that is what? That is taxable. And it will lead to deferred tax liability. Positive. Other VATs will report a positive view unalipa. So all taxable temporary differences will lead to deferred tax liabilities. While this negative is when the carrying amount is less than the tax base. So let's write it formally by you saying taxable temporary differences. It is the temporary difference that will result. It is the temporary difference. It is the temporary difference that will result in taxable amounts. That will result in taxable amounts. Full stop, another hyphen. They arise when the carrying amount, of an asset or liability, carrying amount of an asset stroke liability is more than the tax base. It's more than the tax base. It's more than the tax base. Full stop. They give rise to deferred tax liabilities. They give rise to deferred tax liabilities. They give rise to deferred tax liabilities. Full stop. That's enough. Go to deductible. Deductible, temporary differences. Deductible, temporary differences. You say, are temporary differences that will result in amounts in determining that will result in amounts that are deductible. Results in amounts that are deductible. Results in amounts that are deductible in determining taxable profits. Taxable profits. Full stop. If you don't want that, you use this one. It's also okay. They arise when the carrying amount. They arise when the carrying amount of an asset stock liability, the carrying amount of an asset stock liability is less than the tax base. It's less than the tax base. It's less than the tax base. Full stop. Another hyphen. They give rise to deferred tax assets. They give rise to deferred tax assets. They give rise to deferred tax assets. Full stop. Next, deferred tax liability. Deferred tax liability, another definition. Yeah, another technology. No, not technology, terminology. Another terminology. Deferred tax liabilities. Then you say, is the amount of income taxes payable in future periods. We are on deferred tax liabilities. The amount of income taxes payable in future periods in respect of taxable temporary differences. I repeat, the amount of income taxes payable, I'm repeating, the amount of income taxes payable in future periods, payable in future periods, in respect of taxable temporary differences. Respect of taxable temporary differences. Full stop. So Purity, you are asking, those are you, Peter, but don't worry, Thomas, as you are back here, Thomas, you will do the necessary. Yeah, you will share, don't worry. Then deferred tax assets, another terminology, deferred tax assets. Deferred tax assets, then you say the amount of income taxes recoverable. The amount of income taxes recoverable in future periods, in respect of recoverable in future periods, in respect of full colon Roman 1, in respect of Roman 1, deductible temporary differences, Roman 2, the carrying forward, look at it, it will make sense. Carrying forward of unused tax losses. Carrying forward the unused tax losses. And Roman 3, the carrying forward of unused tax credits. The carrying forward of unused tax credits. Full stop. And the last definition, permanent differences. Permanent differences. About the theory wanapenda sana. You say are differences which arises permanent differences are also known as timing differences. They can use them interchangeably. Timing, permanent. You say are differences which arises when an item has been considered, in one profit computation, but ignored in the other profit computation. I repeat, are differences which arises when an item has been considered in one profit computation, but ignored in the other profit computation. E.g., for example, depreciation is recognized in accounting profit computation. Depreciation is recognized in the accounting profit computation. But disallowed for tax purposes. So you put it in this profit, ukienda huko kwingine unakataa. So those are called permanent. They are permanent differences, which is just one and the same. But down there, down there. Deferred taxes are computed from paragraph now. Deferred taxes are computed from either, yes, that one will sound better. Deferred taxes are computed from either full colon. Deferred taxes are computed from either full colon Roman 1, permanent differences, from permanent differences, and Roman number 2, from temporary differences. From temporary differences. So when you want to get deferred tax, you can compute it from the permanent or from temporary. So niweke hapo mbele ya temporary ka hyphen. I don't know how you will put it, but temporary is the one recommended by the standard. So sijui utasema you weka hyphen highly recommended by IS number 12. The standard highly recommends temporary for computing deferred taxes. For reasons which I can even say once you have seen the differences. So hapo kwa permanent tunapita tu, but tunaenda kuland kwa temporary. So down there you can say this: when applying permanent differences, when applying permanent differences, comma, deferred taxes are to be determined as follows. So you say permanent, sorry. So it's determined as follows. So deferred tax will be permanent differences times what? Tax rates. So the question will be, how do you get the permanent differences? So you say down there, where, let me respond to a student here. All right, so maisha ni ngumu. Baadhi ukifikiria mmechoka, watu wa hivi ni kama day. Imagine early morning, hebu sikia maisha ya early morning. Early morning jana wamekuwa hapa. Tumetoka class saa ngapi? Wenye walikuwa, si wenye walisikia. Tulitoka class saa ngapi? Silikuwa 8 p.m. Walitoka hapa class 8 p.m. Hao ndio early morning. Na saa hii tena wakarudi 7:30. Na tena mkimaliza tunamaliza around 10:30. Wao tena wako na class 11 to 1. Si ndio? Si mko na FM ama? Hiyo ndio maisha yao. But God knows why. God knows why they had to take you to early morning. Let's proceed now. Where were we before I was interrupted? Oh, where permanent differences. But have you ever sat down and studied life keenly? Life is very funny because let's say when we were in high school, let's start from high school, then when I come back to Kisonga. When people were in high school, ulikuwa nasema hadi ule kutoka na ule mwalimu alikuwa na mshaka wapi? Asubuhi 4. Ati unaenda ilikuwa preps hapa whatever it was. No. 4. So ulikuwa unajikakamua ukisema after this. Mara tu hivi nitalala. Ndio. Nitalala alafu najiconsult nasikia ati in college ama campus hakuna regulation, unafanya mwenye unataka. After that, who's in the go? Actually, life moves like that. Life moves like that, and it is like that by the way. So kuna mtu ako na soft life, and very soft. I don't think, because after all that again, unasema wacha ni struggle, wacha ni struggle nitapata job mzuri, ama nitapata job mzuri. Tena ukipata hiyo job, another stress. Unakaa unasema wacha nikuwe mkubwa. Ukikuwa mkubwa kuna wakubwa ya wakubwa pia. Another stress. Unasema sasa wacha nianze yangu. Unaanza yako, suppliers wanakusumbua. Unasema afadhali kukua kwa mwingine. That is how life behaves. So very asema pambana tuna hali yetu mpaka Yesu arudi. Sasa usikie hiyo maneno. So where permanent differences is equals to, how do you get permanent? Permanent, you take, it should be the disallowables, yeah. Disallowable expenses, like in a depreciation, minus the allowable what? The allowable expenses. If you take the disallowables minus the allowables, you get the permanent differences. You know, unajua sasa hivi unasema tukimaliza CPA life will be okay. Kukuwa na hiyo CPA Kenya, sasa uitwe CPA Ruth. Unamaliza hiyo CPA, you know life is very fun. Unamaliza hivi, ukifika tu mmeenda forum ISPA. Wewe sasa juu unafikiria sasa umeanza kuringa unaitwa CPA so and so. Unakuta wengine wanaitwa FCPA. Unajua kuna hiyo jina? The fathers, now these are the fathers of CPA. When it's time to talk, you keep quiet. F, fellow. So unaenda tena unanyenyekea, unakuwa sasa junior. And they can monolize you as well. So you accept. Then let's go to temporary differences. This one is not highly used because it is based on profit account. Profit keeps on fluctuating. This is based on the balance sheet, on the assets and liabilities. It's the one which is highly recommended. So temporary differences, the life has no balance. Temporary differences, you say, under that, we have already defined them, so there is no need to go back to definition. You just say deferred tax. So you're using this method, then deferred tax is equals to temporary differences times what? Tax rates. Times the tax rates. So how do we get temporary? Though we have said, but now let's move procedurally. We talk about the illustration. So temporary differences. What was the formula? You take the carrying amount, correct? Carrying amount minus what? Minus the tax base. And the carrying amount we said is the net book. I want to break it, break until it sinks down. So temporary differences is equals to carrying amount minus tax base. Carrying amount is the net book value. Tax base is the written down value. Net book value is the cost minus accumulated what? Depreciation. Written down value is the cost minus what? Accumulated wear and what? Wear and tear. Vivo. or capital allowances. So in the questions, we'll highly be focusing on that. We are highly focusing on that. Note. Exempt. Unaona exempt what? Exempt. Unaona na zero rated na exempt. So start the word goods. I just want anything which is exempted. So just write exempt transactions. Yes, let's put it that way. Exempt transactions. Exempt transactions. Exempt transactions. And goodwill. And goodwill are not assessed for tax purposes. Are not assessed for tax purposes. And therefore, just in case we get them, and therefore, they are deemed to have nil tax base. They are deemed to have nil tax base. Nil tax base without temporary differences. Without temporary differences, regardless of their carrying amounts. Regardless of their carrying amounts. Full stop. Regardless of their carrying amounts. Full stop. That is very important for your consumption. If they tell you something has been exempted, it was recorded as 1 million. The carrying amount, you know, the book value is the carrying amount. Tax base will always be 0. Ama unaweza record goodwill, ukisikia the government now from today, ukisema goodwill in the books, they tax you. Will people declare goodwill? Hello? Will people declare goodwill? Unaweza kuambia watu sisi tuko na goodwill. Sikiaria watakutax. So anything exempt or goodwill, regardless of the book value which is there, tax base will always be, because immediately you capture tax base, that thing will have a temporary what? Difference. And once you have temporary, you see what will happen. It will be subjected to what? To tax. So even if in the question, now after those ones, I'm really focusing on the question, even if you have carrying amount of goodwill and any exempt item, please ignore them for tax base and also record here temporary what? 0. Another item which might be important to us, temporary differences is not assessed. Temporary differences is not assessed on equity and other reserves. On equity and other reserves, including other reserves, including current taxes. You don't assess tax on tax, including current taxes. Full stop. Because you know in the reserves there is retained earnings, and retained earnings kuna tax which affects the profit. So we don't assess ukifika kwa equity, any equity, ordinary share capital, share premium, retained earnings, revaluation, please don't assess them for tax. Then you find that the government or anybody, you know, when you are coming up with something, you can have patented rights. So we have patents, copyrights, all those intangible assets, the intellectual properties. Most of them, you find that in year 1, you are always allowed. they allow the whole amount for tax purposes. So if the whole amount has been allowed for tax purposes, then it means the tax base will always be what? 0. But if they have book value, that book value must be assessed for tax, so they still have temporary. I think I've said a lot. Veronica, repeat. That's from where would I to me? So Noli will share everything. Please get out your past papers. Me, I'm tired. I want us to do now illustrations. We are stopping at 10:30. We can do like how many? 6. Yes. Yeah? As much as we can. Okay. Get out your past papers. Where? Let's meet in May 2017. But currently in the new syllabus, there's something wameongeza kwa hiyo topic. Wamesema we focus deferred tax on group companies. Hii consolidation tunaongelelea. That we tried also to check deferred tax for group. So I will have that kind of question before we finish. Not the semester, today. For group. May 2017, are you there? I've been looking for it. Oh, this is which question? Let me see. In 2018. Page 97, page 97. My paper is different with others. I'm told page 97, question 4. Question 4B. Are you there? Hi. So May 2017. Question 4B. I hope you are there. Deferred tax is feared by so many students for reasons which I don't know. But I believe by the time we are finishing, it will not be an issue to you. Issue means, where's the patana swali deferred tax? Useme that one you can't. So I read Manro Limited, Ama. It is Ma Ama Mu. Whichever Ma it is. That's Limited, a manufacturing company, provides for deferred income tax in accordance with IAS number 12 income taxes. The following is an extract from the statement of financial position as at 30th April 2017. Let's go to the additional information. Let's go to the additional information. So additional information number 1, the tax basis of the assets are as follows. So we have been given tax base of some assets. property, plant and equipment, prepayments, interest-bearing loans, financial assets available for sale. Before I go to number 2, there's something I want you to record. Assets, unless otherwise, assets are recorded that they are carrying what? Amount. So the values in the balance sheet, the ones we are seeing in that balance sheet, they are the carrying amount, unless we are told that is not the carrying amount. But it is always assumed that assets are recorded that they are carrying what? Amounts. Number 2, inventories are stated at fair value, less cost to sell, which is lower than the original cost due to a general provision for price decline of 3.5. No issue. The intangible assets comprise development cost, which is tax deductible when the amount is paid out. The cost of intangible assets was paid in 2014 and is presented net of amortization costs, which are mixed. Number 4, goodwill and employee benefits are tax what? Exempt. Trade and other payables include provision for leave allowance of 1.4 million, which is tax deductible on cash basis, meaning when paid. Trade receivables are stated net of general allowance for bad debts at the rate of 5% of the gross receivable, no problem. The general allowance is no tax deductible until it becomes specific. The building, which is included in the PPE, was revalued during the year. The increase in value of 3 million does not affect the tax base. Okay, the tax base of other items is equal to their carrying amount. So other items which have not been mentioned anywhere. So if we come across any item which has not been mentioned in any note, then we assume the carrying amount is the same as the tax base, meaning temporary will be 0. Because how do we get temporary? It's the carrying amount minus tax base. So if they are the same, then it means temporary is what? 0. The tax rate applicable is 30%. Required deferred tax balance as a 30th of that, then deferred tax income account. The account is only 2 marks, but deferred tax is how many marks? 12. Is 12 something to joke with? It's serious. So let's write there. Manro. Kwani mnasema ni move na sifa? Kwa nini hiki kilikuwa kigumu? Kama kuna kama na kitu kingine pia. We are going to use this one to set what? Grounds. Ground ilisha kwa kapeta. Sasa hivi tumia wa lingine. Kama tulikuwa na the ground has shifted. Or the ground is just speaking about you. Come on. Some of the ground is talking where? Then you give the smile. So all those questions just use temporary, permanent. So how do we get temporary? For you to get deferred tax, yes? For you to get deferred tax, first you need to get what? Temporary. So what is the formula of getting temporary? You take the carrying amount, you subtract what? Tax base. So let's do this. So right here, assets and liabilities. Assets and liabilities. Carrying what? Carrying amounts. Here we report what? Tax base. So when you take, and this is always the layout. This is how you present. So carrying amount minus tax base will comfortably give us what? Temporary differences. Then once we have the total temporary, we multiply with the tax rate and we have deferred tax. So shillings are in thousands. Shillings are 1,000. So have that. So have that one there. So we check them from top down. Top down. So we have said that those figures appearing in the balance sheet represents what? The carrying amount, unless they say something contrary. So property, plant, and equipment. PPE. Right there, PPE, property, plant, and equipment. How much is the book value? 14. Were we given its tax base? The Somerset Fully tax base, so we just in note number 1, the tax base PPE was given as how much? 28. So the difference, actually, ukiangalia watu, huyu anakuanga accountant, huyu anakuanga the tax man. So the difference is temporary. This minus this. Chapter. Ruth. 11. Next, intangible assets. Intangible assets. What is the book value? 4,000. Tax base. It was talked about somewhere. They were mentioned. Which note? 3. The intangible assets comprise development cost, which is tax deductible when the amount is paid out. So listen, kidogo. They are saying it is tax deductible when amount is paid. Tax deductible means you are not supposed to pay. You are allowed. It's allowed. So if it's allowed means it's not payable. The tax should not be assessed at that point. The cost of intangible assets was paid in which year? 2014. We are in which year? 2017. It means they are communicating that that amount was allowed in 2014 and is presented net of amortization cost, meaning tax base is what? 0. There is no tax base because they are saying it is tax deductible. Tax deductible means it's allowed for tax. Allowing for tax means it should not be subject to. That cost by that time should not be subject to. When the amount is done, what? Paid. So the question is, when was the amount paid? 2014. So it means there is no tax base. But we are still seeing it having a book value. That book value must be subject, must be assessed for temporary differences. Next, goodwill. Goodwill is a special case. Goodwill is how much? 6. But other work is goodwill, was but they said it was exempt. But even if they don't say, goodwill is not normally assessed for tax. Tax base, hakuna, other temporary, hakuna. Regardless of the book value. So if you declare that it antaliwa. Intangible assets will check because if they were allowed, why do they still record the 4? So financial assets available for sale. Andika tu AFS available for sale. Marcus wote wa customer wanajua hiyo AFS available for sale. That is how much? 12. Was it mentioned somewhere? Not? Or 1. Tulipewa. How much? 14. So this is 2 negative. And by the way, it's not a must we write, but for your attention, you need to know that positive are called TTD and negative are called ETD. TTD stands for taxable temporary differences. Positive is taxable, while negatives are deductible. Yes. The negatives are deductible. Alright. Next, inventories. Inventories 75. Was it mentioned? Note number 2. Check note 2. Check additional information number 2. Number 2, inventories are stated at fair value, less cost to sell. At fair value, less cost to sell, which is lower than the original cost due to a general provision for price decline of 3.5. So they recorded net of the price decline of 3.5. Taxman is coming to check the tax base. So tax base is very simple. According to story B, how will you get tax base? You take the cost minus where and what? There. So when taxman comes, they will ask you, what was the cost of that stock? Because you know people will say there is price decline or boost the value with some ill tax motives. You know? So the taxman will ask, how much was the cost? What was the initial cost before? You know this amount is net of the 3.5. So what was the original cost? Gross up the 3.5. It's in 11. So the initial cost of the stock was 11. Then they subtracted price decline of 3.5. Then the book value is how much? 7.5. So for accounting, this is okay. But for tax, taxman will say no. It was 11. Was there wear and tear on stock? No. Then the taxman will assess tax on. If there is no wear and tear, then the cost is the tax base. No negotiation. Ushike adabu. Next time hakuna kupunguza vitu kwenye unajisikia. So that one takes us to 3.5, which is deductible. Stock is taxed on sales. So we cannot tax stock. When does tax stock, then would you tax sales? No, stock is taxed on sales. That is why should there be any tax variation, it is always deductible with a benefit on your side. Lynette, I didn't get that right. With us, we have gotten it right, 3.5. Right means the explanation. Oh, the 11. So we are saying for tax, taxman will initially check the costs minus if there is wear and tear. And if there is no wear and tear, then cost becomes the tax base. So you ask yourself, you know, for them to record 7.5 from what they are saying, it means the 7.5 was net of the price what? Decline. So the taxman will not allow you to say that there's a price decline, so we have reduced. No. The taxman will gross back to costs. Then check whether there is any wear and tear. If there is no wear and tear, then the cost is the tax base. So Lynette, I hope you have understood. So I will proceed. Receivables. Receivables has been recorded at what value? 66.50. Was it mentioned somewhere? Was it mentioned somewhere? Not number? 6. Not 6. Trade receivables are stated net. Net of what? General allowance for bad debts at the rate of 5% of the receivable. The general is not tax deductible. It means it's not allowed. So, but even if they don't say, they are saying this has been recorded net of bad debts of 5%, provision 5%. So it means this figure is at what percentage? So this is 95 because they have subtracted bad debts. Taxman hataki kujua hiyo. So unajua bad debts na KRA kwenye kunaenda. Ati unaenda kwa KRA walikataa kulipa, so ndio lipa kwanza, then bring sufficient proof that they refuse to pay. It's not an easy issue that you just subtract. Gross it back to 100%. So once you gross it back to 100, we get the cost. Unajiuliza, was there wear and tear? Which kuna, then the cost is the tax base. So what do you get when you take it back to 100? 7,000. So back to 107. There is no capital allowance. So even receivable should be taxed on sale, though not always. So difference is how much? 350. Deductible. But it is easy when you understand. Deferred tax is not hard. When you do it, complicated. All right. Next, prepayments. Prepayments. What is the book value? 30 what? 3,200. Was it mentioned anywhere? If not mentioned, then tax base is 32. They said the same. Was it mentioned? Yes. Not 2, not 1. Tax base for prepayment is how much? 15. So temporary is the difference. Temporary is the difference. Huh? Not 1. Let us do additional information number 1. 17. Next, after prepayments, cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. How much? 12.50. Was cash and cash equivalent mentioned anywhere? If not mentioned, you go to note number 8. If not mentioned, you go to note number 8. Yaiko? Yes, so the same. Next, we go to equity. Don't assess tax on equity at all. When you start taxing people's capital, atukifungua kampuni na capital KRA will be charging you on capital. Tutasema hapo ndio unasikia kizungu inakuja. Ati unasemanga kama ni bucha ati mulianza na nini? Inakuwa idea hapa. Hadi mulianza na photo. Au inakuwa ulianza na supu ya nyama. Hatukuwa na capital. Nilienda kwa bucha nyingine. Nikapewa supu na nikakuja nikauzia mwingine hapa, sikukunywa ama nilikunywa nusu na nikauzia mwingine. That's how we started. So nobody will ever declare capital. So equity, ignore. We don't assess tax on equity. Non-current liabilities, interest-bearing loans. So we have interest-bearing loans. So interest-bearing loans, which interest? You got a loan, you got interest. 16, but remember, this is a liability. There is no way you will add liabilities to the assets. So liabilities kindly subtract. So, was it mentioned somewhere? Interest-bearing loans. Not 1. Yeah, not 1. Interest-bearing loan, how much? 17. Kindly subtract. So here we will have positive. Minus 16 minus 17 is positive what? 1. Yes. Next, we are moving on well. Deferred income tax, don't assess tax on tax, ignore. Actually, that is tax at the start of the year. So you are and I. Let's go to trade payables. We are dealing with the 2 payables, then employee benefits, then we are done. So, andika payables. Kuna mtu hajauliza swali hapa. Hapo kweli. Terry, are you here? How comes you are quiet? Please. Terry is not around. Very unfortunate. So payables is 8,000. Was it mentioned somewhere? Note number 5. Check note 5. Trade payables includes a provision for leave allowance of 1.4. So this 8 includes 1.4, which is tax deductible on what? Cash basis. So tax deductible on cash basis means when paid. Cash basis means when done what? Paid. So of the 8, 1.4 will be only allowed when paid. So toa here 1.4. So from 8, subtract the 1.4. The 1.4 will be allowed when done what? When paid. So for now, we have not been told whether it is paid, so you disallow. So 8 minus 6.4. 66. So that 1.4 will be there. There. No, itakuwa negative. See, liabilities we are subtracted. Then finally, because we are not checking tax on current tax, employee benefits. So employee benefits. Imagine this is the procedure for doing deferred tax. 2000. 0. It was exempt. So employee benefits, you don't want with the holding and a final. So you don't again subject nothing. Kusha, we are done. Unless someone has a question, I want this total. Don't add for me the carrying amount, don't add tax base. This is what is marked. This one here. So give me the aggregate of all that. If you have a question, please throw it on. We check. Was trust your calculator. Kidogo too, I answer Faith. You did not understand where we got the 1250 tax before cash and cash something. Cash and cash 1250. Oh, Faith is saying she cannot see where this 1250 is coming from. Wait, kidogo musikibie mbio. Can somebody online tell us where we are getting the 1250? Why did we show here 1250? Then again, Boniface, how did you get 7K under receivables? Again, somebody to answer Boniface, where did you get this 7? So I want to see where the 1250 is coming from and 7 is coming from. That is on the online platform. Otherwise, you are saying total is 10,650. So I think up 10,650. Justus is answering for 1250. Maybe Faith, can you refer to note number 8? Then for the 7, you are being told kindly. Okay. Read addition. No, you're bothered with Faith. So umemalizana na Faith. Hebu muende sasa kwa huyu mwingine. So Alan is answering Okini. Adding back 5% provision. Yes. Which Susan is telling you, tax receivable 6650 is at 95%. So 100% is 7,000. So Boniface, I hope all those explanations are helpful. Faith, umeelewa hiyo kitu wanasema? Note number 8. Note number 8 wanasema kitu yoyote yenye ni kitu yoyote ama kitu? Anything and not mention, you go to number 8. Monica is asking, how do we treat note 7? We check note 7 before I come. How do you treat note number 7? Note number 7. Oh, it's coming later. It's coming later, Osana, and I'll show you. I'll tell you how. Therefore, therefore, nakala mtofauti. Therefore, deferred tax. Are we going to report deferred tax asset or liability? liability because your aggregate temporary is positive. Positive is a liability. So deferred tax liability is equals to 10,665 10,650 times 30% times 30%. So that is the deferred tax liability, which comes to how much? 31,995. 12 months. So 12 is 1, 2, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10, 11. Where is the 12 coming from? Huh? And to mark the 30%. Oh, your total. Yeah. No problem. Let's go to Roman 2. Let's go to Roman 2. Roman 2, they want us to prepare deferred income tax account. So right there, deferred tax account. Deferred tax account. Deferred tax account. Shillings are in tax. So there we are. What was the balance brought down in 2017? So what was the deferred tax in 2016? Go to your balance sheet and current liabilities. Check for me the deferred tax 2016. It was 1,200. It can also appear under current assets and deferred tax asset. So if it's an asset, you bring it down on the debit side. But it's a liability, you bring it down on credit. So you say balance brought down. Balance brought down. You have said 12. Capture it there. That was the deferred tax at the start. Then at the end of the year, because the balance sheet, all these transactions we have been dealing with, the carrying amounts, they were at the end of the year. Because balance sheet is prepared at the end of the year. So at the end of 2017, we have determined a balance carried down of how much? 31,95. This one. So iko shida inakuanga hapa kwa deferred tax, and you need to understand. Check here. When we opened the year, deferred tax was 12. When we are closing, deferred tax is 31,95. It means the increase from here to here is what came during this year. So what came during the year is what we need to charge our profit and what? And loss account, the balancing figure. So the balancing figure here should be the difference between this and this. But now we are not going to do that because of one reason. Now note 7 comes in. So go to additional information number 7. Go to additional information number 7. They were saying the building which is included in the PPE, building iko ndani ya PPE, was revalued during the year. The increase in revaluation of 3 million does not find. Now, revaluation took place when? Revaluation, as per that note, revaluation took place when? During the year. The PP in the balance sheet which we have been given, we were given when? During or at the end? At the end. Sure. So it means the value of PP, which is 14, 14 is inclusive of what? Revaluation. Because revaluation took place during. So it means at the end of the year, the revaluation has already been captured in what? 14. So I want you to listen and listen carefully. Inside this 14, okay, when you revalue, you have to tax. That is the truth. even in Guinea, the normal, when you revalue properties, then you sell off. So unalipanga CGT, the capital gain. Yes. So inside the 14, there is 3 due to revaluation. But revaluation, that's my type of case story. When you are revaluing, because what unachezanga kwa revaluation, wanaletanga value, wale anakujanga, mostly value anakujanga asubuhi na navanga wanakuanga na gari ya white, sio? Alafu anakuja hapo anaanza kuandika vitu ovyo, anakuambia na if again, can we talk? Then namwambia understate or overstate depending with what you want. So taxman atakali kujua hiyo story. Ukioverstate sawa, enda ulipe capital gain. So it will never, even if the examiner never said, it has no implication on the tax base. So it means temporary will always increase or decrease with the proportionate value of revaluation. Because you have to look at 3, you go up and down. So it means revaluation, there is also how much, temporary, there is also how much? The 3. And that 3, you're gonna effect on the aggregate. You go up and down. And that 3 has been done what? Taxed. So temporary. So inside, I want you to understand it properly. Inside the 3195, there is that part. The revaluation was 3 million. 3 million by 30, 900. Sure. Yes. So inside 3195, there is 900, which was a result of what? Revaluation. Which was a result of revaluation. But now, another problem we are having, a serious problem, revaluation, you have told me that the difference between 12 and 3195, the increase should go to the profit account because this is during the year. But now you know revaluation is not a profit component. You know, revaluation is a capital issue. Ama, do you bring, when your assets gain value, do you bring it to the income statement as part of income? It's called other comprehensive. It's an equity component. Revaluation is an equity, it should go to the balance sheet. So to know what is going to the P&L, you need to subtract. You need to subtract revaluation. So out of the 3195, if you want to know what goes to P&L, subtract the part which was brought by what? Revaluation. So how do I subtract? You subtract by crediting the account. So you say revaluation gave you 900. Do we agree that when we credit to Metoa, is it true? When we credit the account, we have reduced this. So see, by you credit the account. So you credit here 900 to Metoa. So that P&L, the balancing figure, P&L, the balancing figure will go down. Revaluation iende kwa balance sheet, isiende kwa P&L. So that was the effect of note number 7. How much do you get for P&L? 1090, giving us 3195. So we are going to generate the deferred tax account. Most of this level, wanakwanga feature revaluation mahali. But inakwanga already adjusted here. So don't interfere with the temporary. Just leave it. You will come and subtract it from there. As simple. Come on, a loss, it can also be a loss. You just do the opposite. And now your side again. We are done with that question, but there is a question they normally ask. Very frequent. I don't know why it is missing there. So add in your past paper Roman 3. Na detect macho ya watu naona njaa. Watu amukunywa chai asubuhi. Roman 3, journal entries to record the changes. Journal entries to record the changes. We have 3 more questions to go. Journal entries to record the changes in deferred tax. It's a common question. I don't know why it is missing. Journal entries to record the changes in deferred tax. But in exam, the common question is missing. Just ignore. But it's likely to. Now, Monica, not Monica. At how many marks? Oh, the journals. The journals should just be 2 marks. Come on, the journals. But this one was also 2 marks. And this one is marked this way. This one. Okay, wakiwa wazuri, wako na good heart. They will mark it this way. If they have good heart, then they say, what? Half. If they are bad-hearted, wataki story mingi watu wapite, waende ispa, then they will mark those 2. 2 times 1. Silikuwa 2 marks. Yes, then those 2. Hizo zingine wanasema sio ni obvious. So journal entries. Any moment you are asked of journal entries in accounting, you are being asked which accounts to debit and which accounts to credit. So journal entries. You debit and you credit. Wait, are you people practicing social responsibility? Yes, sir. Okay, giving back to the community. CSR, right? Do you normally practice it? So how can I give that back to the community? You teach for free. Now, learning for free. That one you are not giving, you are being given. I have that. Free tuition. Okay. That is the giving back to the community. Alafu community wanaweza kutukana. Yeah, it's very possible. So when they tell you changes means how did it come from 12? The opening was 12. So how did it change from 12 to 31.95? So what you pass in the journals are these 2. Not opening and closing, because changes means how did it change from opening to closing. So pass this 2, which is simple. You have credited the deferred tax account with what? Revaluation. So the corresponding debit should be which account? Revaluation. So number 1 will be debit revaluation reserve account with 900, because you have credited deferred what? Deferred tax account with 900. That is the first one you are supposed to give. So, then you give a narration, you say, to record, I'm short of space, so okay, the best practice in assemble ukipeana journals, you must tell us what you are doing. Kuna watu hapa wanapitishaka general journal kwa system na wasemi kitu wamefanya. Unajijua? Ambishia tu. Asemi kwa system kitu wamesema. Audit trail kitafuta hakuna. You say to record deferred tax on revaluation. To record deferred tax on revaluation. That is one. The other one, let's pass this one here. We have credited deferred tax with the 1095. So you debit P&L. So debit profit account, profit stop loss account with the 1095, because we have credited deferred tax account 1095. To record deferred tax for the year. Narrations, you can give anything to record deferred tax for the year. You just say whatever makes you happy. Whatever you think is appropriate for you, well and good. Now, I have said we are remaining with 3 more questions. So we are not going to waste time. I'm giving you 5 minutes break, but I'm leaving you with a question. You start, kuna watu wataki break. So I'll answer immediately. November 2019. November 2019. November 2019, question 5B. November 2019, question 5B. So I'm very time conscious. Musiende bali, just be around. But you can take water. 9:43, I'll be back. So you can start checking on that question. First explanation to record deferred tax on revaluation. Sharon, deferred tax on revaluation. Bus, we are back. We are back. Break is over. During that break. So from next week, make sure you become into your team. So let's go to, it is which one? 2019. Question 5B. November. Yes, I'm there already. I'm already there. So it says Mafuta Limited had a deferred tax liability as at 1st October 2018 of 400. I hope that is the opening. For the purposes of preparing the financial statement, the following additional information is available. We cannot treat those things. You go to required. Required Roman 1, the relevant temporary what? Differences. Andika hapo. Mafuta. Are you mocking elders? For the year ended when? 30th September 2019. So just the same thing we did. Shilling mkifurusha macho hapo unaona inafaa ikuwe millions. Correct. So have that arrangement, then we kick off. The learning curve sahii itakuwa juu, so we might not waste much time on that question. So we start. I hope everyone is ready. So we kick off. Number one. So we just go number by number. They're always independent. Note one, we rarely find note one if we're going with the note two together. So just go one by one. Number one, the company has available for sale financial assets. They are thinking to get something, at least they'll capture something. Available for sale. So available for sale, financial assets with a carrying amount of how much? 8. What has been said, you capture immediately. And financial asset at fair value through profit and loss of how much? 40 million. There's another one. Financial assets through profit and what? So that one in full the sub and that one has a value of 40. You are going with what they are saying. Continue. Both financial assets had. That one had is very serious. And that one reported losses in a fair value of 8 million each. So it means, okay, not it means. I want to ask you, this 80 and 40, because they're saying each of them had lost 8. This 80 and 40, it is net of that loss, or the loss is still inside. It is net. So as much had lost, and even they are calling them the carrying amount. Right? So when taxman come, what was the initial cost? You will explain later. Yes, they were net. So gross them back to get the cost. There is no wear and tear. Taxman will assess the cost. All are deductible. Let's go to number 2. Inventory. So thinking begins after you have written inventory. Inventory is shown at the law of cost and net realizable value. The cost is 32, while net realizable value is 31.20. Which is which? More than the carrying amount and the other one should be tax based. Which is which? There? 31.20 is there? The carrying amount, the realizable. So 31.20 is the carrying amount, while cost becomes the tax base, which is how much? 32. Giving you a difference of 80 deductible. Next, number 3. So number 3 anajipia mnifanyie for once. Receivables. Hebu soma na uandike kila kitu. There is no harm in attempting.
What are they saying? Receivables are carrying amount of that sound. After making the levels for that was that, so we can take it. So again of 160 million.
Sawa. Pass. Hapo kwa carrying amount wacha tusisumbuane. That is how much? 2 million. Now when we draw the lines, it's on tax base. So Ruth yako ni gapi? 20? 2080. 2080. 1920. Kila mtu aseme yenye ako nayo. Joy 1920. Wewe unasema 1920. 2240, 2080. 2240, which is which? Online, only one person giving. You just throw. People have different answers here. 2240, 2080, 20. Again, 2000. Yes, you yake. 2080, 1920, 2080. Okay, of those, all those answers, there is one which is correct. You have changed your mind to 1920. Okay, yeah, you have right to change. Anyway, the correct answer is 1920. 1920, isn't it? Thomas, can you tell us how you have changed your mind?
Yeah, people have changed their minds.
So,
so the carrying amount is 2 million. Then there was an allowance for doubtful debts, for which it's not allowed taxman.
So we gross up.
So we gross up. And then it's an exchange gain. So we need to it's a negative, it's a less. It's a gain.
Ruth, you also changed your mind.
Yeah.
How did you change?
So the carrying amount of 2 million is already inclusive of the 80 and 160.
No, we gross back the 80. So, no.
Oh yes, and then we deduct.
Yes, because this is a gain. So it will be 2 plus 80, but remember the exchange gain is 160. So if it's a loss, fine to get add. But this one was an exchange gain. So it means they had used it to reduce. So add, subtract it out. So it comes to 19 what? Great. That is what the taxman will check. They will not check on that exchange. 80. Is there anything? How did you get 1920? So can you ask right now? If you have not understood, gross up the loss, which is allowance, but the exchange gain is a gain, so you subtract. No, there are no people, that one you have understood. Then next, number 4. Where are the payables? Payables. And remember, payables is a liability. So remember to subtract. Are stated at 36. Stated, that is the book value. Stated at 36. After making a provision of how much? 40. Gross back. Sure. 36 what? 40. We have 40. Huh? 40 positive. Yes, it will be positive. C minus 36 minus positive 40. For the liabilities. Liabilities are the opposite of assets. Number 5, PPE. PPE has what? A carrying amount of 48. And a tax base. Ukisikia tu hiyo tax base, hata ukisonga utajiconfuse. Utaona vitu mbaya mbele. 4. Don't usisome mbele. 8. Sasa tuende tusome na hakuna kuchange. So umesema carrying amount a tax base. Why do you want to destroy? Some land and buildings were revalued upwards by 200. During. So it means it is included. So you it affect to deferred tax account tukisonga. Sawa? So it is okay. Hata kama ukikuwa unajua, so wamesema carrying amount na tax base. Don't interfere. But during means within that year. So the balances at the end of the year are inclusive of the revaluation. Sure. Yes. Number 6, intangible assets. Intangible assets. What about it? Consists of trade licenses being 5 years and a carrying amount of 240. This was allowed for tax purposes in full 2 years ago. Tax base. So the old amount was allowed. So 0. Now, when anybody wants to record, we will assess that to 40. Assume tax rate of 30. We shall. After exam, I want to do temporary, but you now defer tax. Deferred. I don't know they want journal entries. You can put it to defer tax. But what the examiner wants is that. How many marks? 8. 1, 2, 3, 4, 5, 6, 7. Total? 10? 10, 80. Are you sure? When you may come out with I don't know whether it is true. See 1064?
1064.
1064, yes. At your ink pia 1 mark. Ink gun. Si umekuja uandike basi na opposite end. Pencil. Usiandike na pencil. They won't mark. Imagine upate hauna results, alafu naambiwa for further explanation visit custom. Alafu naambiwa kupata juu haikumakiwa uliandika na pencil. So go back and write for another 3 months. So that is it. Then now check required Roman 2 journal entries to record changes in what? Deferred tax. So why to put your deferred tax bus? Because to get the changes, I must do deferred tax account. Deferred tax account is the working which is going to help us to come up with the what? The journals. So therefore, deferred tax liability, this is a liability, will be 1064 by 30%. What do you get? $319. 319.2. Let's come up with deferred tax account. Deferred tax account. Really working. So it's not required. So tunasonga mbio. automatic or make here millions, nobody will mark. How much was brought down? You had it somewhere there. Where the question started. It was 400. Carried down 319.2. But 319.3 kuna zingine zimeletwa na revaluation. So credit to remove the revaluation. So revaluation 30%. What was the revaluation in that note? Still a PPA. Huh? 200. So what is 30% of 200? 60. Oh. So this thing is balancing this side. So P&L balancing figure. I hope the 200 was a revaluation gain, not loss. It was again, eh? So upwards is again, yes. That one gives you 140.8. 140.8. So this is for 60. But hey, there is an issue. There's a problem. Kindly, just stop. Kuna shida. Shida imeonekana note number 1. There's a problem in note 1. There's a problem in note 1, but it's good we have noted it before journals. In note 1, they said there was available for sale financial what? Assets. And each of them had lost value by how much? Yes, they are lost value by, see, you loss in value of assets, it become a revaluation reports. So it will be, please, we have to rectify our revaluation. It will be 30% of 200 minus 8 minus 8. The net revaluation here. This is note 1, this 2, note 1. Each of them had lost 8 eighths. There was a loss of 8 eighths, so that one we have to capture. Otherwise, we will be doing something bad. 55, Adam, 55.2. Yes, 55.2. Can you alter this instead of 140.8? 136. Right. So let's do the journals. So right there, journal entries. Journal entries. 455.2, the total. So, you understand the total. So, they want it. So, journal entries. So, what you capture in the journals is this one here. This and that. The changes. How did it change from 400 to 319.2? Those two. Hey, the remaining 2 questions na wapatia kama assignment. Mfanye ndio tufanye next week, tukimaliza tunasonga na hiyo topic nyingine. Si ndio? Ni kifo. Gani? All right, let's start with this one. We have credited deferred tax with evaluation. So we debit which account? Evaluation. So DR, CR. So we have debited deferred tax. So this is Journal 1. Deferred tax account. We have credited deferred tax. So we debit which account? Evaluation, sure. Revaluation reserve account 55.2. Because we have credited deferred tax account also with 55.2. Narration you can say whatever makes you happy. They are not standardized. Just say to record deferred tax on revaluation. To record deferred tax on revaluation. Yes, yeah. Ruth, are you okay? All right. Number two, alimoni Mwalimu FM naona ashafika. Now by the way, ameniambia he's even thinking of combining you with evening right now. Because there's a class you missed yesterday, I don't know in the afternoon or something. Alright, then let's bring 136. We have debited deferred tax. So deferred tax account 136. So we credit which account? P&L. So profit and loss 136. That is a deferred tax income. A credit to P&L is always an income. But we usiende kwa hiyo income ability ama we sema to record deferred tax for the year. To record deferred tax for the year. Record deferred tax for the year. Full stop. I'm not proceeding past that. I'm leaving you with these two assignments, but we'll do them in class. I just want you to attempt. But what we're going to buy our you know, when you attempt, it gives me easy work. Assignment, which part was this? And when was that? September 2021. September 2021. I'm giving you two. September 2021, question 3A. September 2021, question 3A. Question 3A. Then September 2015. September 2015. That is pilot paper. The 15 is pilot. September 2015 pilot. Na hiyo pilot tunaletanga na hiyo swali kamweke kwa pilot 15 hawajaileta one day. September 2015, question 3B. Question 3B. So sawa. Jina ya hiyo 2015 is washtue wanajitanga sophisticated limited Sini sophisticated ama sophisticated. So that is not an issue. So if you can attempt, then we'll do in the next class. That one can take us maximum 45 minutes or 1 hour to get us under those two. Then the remaining, we go to another topic. The other topic I intend to pick up. Segmental, we might go to segmental reporting, IFRS number 8. So do have a nice Sunday and a weekend. But day class, we might have a class on Friday also, because Thursday, don't are you listening? Thursday, you know, it's a holiday. And day class will not come on holiday, so we might have a makeup. Because Thursday you do have 2 classes. Sure. We can't afford to lose 2 classes. So we will check for makeup before, after, but within that week. Wengine tupatane kwa limits of the corridor. Early morning Thursday. Thursday tumetikia early morning.